of the economy, though, seems can have to do with, I guess, what we would consider more essential items, or at least items that we need to sort of function in our household versus other items that you would find at mall that would certainly fall more into the discretionary realm. I'm wondering if we are going to see at all a sort of a reorganization, not only of what people buy, but I guess how they buy it, and that we start to move a little bit more back to some of those discretionary items.
Yeah, you're really seeing it well underway right now. I mean, we've seen a dramatic boost in contactless transactions, ranging from curbside pickup to in-store pickup to, you know, direct delivery to home. And consumers are becoming increasingly comfortable with this. I think the digital increase that we're seeing is here to stay. Last year during the holidays, we had about a 17% accountability for digital transactions. This year, it's probably going to be upwards of 35 to 40%. And I don't see a lot of digital give back in those areas. This is one of the trends that is absolutely here to stay. Now, as the economy begins to open up and people become more comfortable going back into stores, I think there'll be some recovery in discretionary next year. And I think the primary beneficiaries are going to be some of the stores like the off-price chains, TJX, Burlington, Ross stores in particular. Other niche players like Urban Outfitters and Lululemon, Tractor Supply should do very well in that environment.
You mentioned some of those discount retailers, and I'm wondering if you're seeing further signs of this bifurcation where the discount value-oriented consumer does very well, and there will always be a place for high-end luxury. But it's that middle of the road that seems to not have a place at this moment. Do you see that?
Absolutely. There has been an absolute erosion in the middle tier, particularly in specialty apparel, as well as the department store space. Macy's has been struggling mightily of late. We obviously have seen JCPenney file for bankruptcy earlier this year. A lot of the mall-based specialty apparel chains that cater to that middle are just don't have the differentiation and aren't getting the sales. They're being undercut by off-price. And then we've seen companies like Target really moving aggressively into private brands and more design, more fashion, and that's taking share away. Target's comps this morning in apparel were up 10%. That's remarkable given everything that we're going through.
How much sustainable is that, do you think, Ken? As we still don't have any fiscal stimulus coming from the United States, we are running into some serious cliffs by the end of the year. Do you think the consumer is going to be able to lend its support to these retailers going past the festive period?
Yeah, that's a great question. I have a lot of skepticism as if whether they're going to be able to do it or not. We're heading into this holiday season with unemployment at 6.9%. Last year it was closer to 3.5%. Consumer confidence around 100. Last year was around 125. No fiscal stimulus. You still have only clawed back about 12 out of the 22 million jobs that were lost so far. So there's a lot of headwinds that retailers are facing once we get through the holiday season, and it's going to be, I think, a difficult slog. Now, the comparisons are really easy next year. First quarter earnings for retail, we track a little over 100 retailers. They were down 60%. They're down 6% in the second quarter, so they're going to have some, relative tailwinds in that regard. But I think it's going to be a little bit difficult unless there is a fiscal stimulus and the job recovery continues.
Yes, waiting on that job recovery. Thank you, as always, Retail Metrics President Ken Perkins, for joining us. And coming up, talks over that additional stimulus. Well, as you know, they've been stalled for months, prompting one Wall Street executive to voice his frustration over a lack of compromise in Congress. We discuss in our Muni Moment, Stephanie Laros-Cillier, Invesco Head of Municipal Business Strategies. This is Bloomberg.
Bloomberg time.
All right, turning now to our deals report. While the financial world analyzes what a Biden presidency could mean for Wall Street, our very own Ed Hammond caught up with White & Case partner Arlene Hahn about what to expect with M&As heading into the new year. Take a listen.
Obviously, the relationship that the president has with other countries is going to impact whether that's, whether it's conducive to more cross-border deals. So I think that remains to be seen. I don't know that we're going to see any kind of sweeping or extreme changes with this new administration. Again, what I think we'll probably see is less rhetoric, less fanfare, a little more transparency and predictability so that anyone in the M&A market can really work with their advisors to understand kind of risk, to understand their advocacy plan going forward.
Another area where we've obviously seen a lot of activity and a lot of interest from the media and others in the market is the rise of SPAC, special purpose acquisition companies, and they are obviously playing a significant role in all M&A, but in tech M&A particularly at the moment. Why are we seeing this emerge as such a trend in this market?
Well, yeah, we can't talk about tech M&A right now or any M&A without talking about SPACs. So SPACs are special purpose acquisition companies, these blank check companies that really provide a third route to the public markets. SPACs have been around for decades, and they're popular in times like these where there's a little volatility and insecurity and low interest rates. But you're right, we've seen an explosion this year. Just to put things in perspective, last year SPACs raised a record $13.5 billion through year end of 2019. At this point in 2020, they've already raised $64 billion. And so just to put, that in scale, I've been an attorney for 20 years, and I think I've worked on one SPAC before this year. In the last 6 months, I've worked on 6 that have already signed, and there's a lot more in the pipeline. And granted, I happen to work with, one of the leading SPAC teams and M&A teams in the industry, but I think what I'm witnessing firsthand is what the market is really seeing. And what they're seeing is that SPACs are very well suited to high tech. And they're also seeing that these are not the SPACs of prior years. So what I mean by that is, the SPACs now, what I think is the big difference is we're seeing kind of a different level of sophistication and caliber of the sponsors, investors who are getting along. These are seasoned CEOs, venture capitalists, entrepreneurs. And so when that happens, when you have kind of that more sophisticated, more experienced investor and sponsor base, that's going to attract a higher caliber SPAC and SPAC target. What that also does is really give the management of the target company an opportunity to get mentoring and to get, experience from the SPAC. And so for any new public company, that's going to be invaluable. But also just, the mechanics of the SPAC are very well suited to tech M&A in particular. So in a traditional IPO, you really have to depend on historical financials. For high growth companies, they're pre-revenue, they're pre-profit. And so they can, with a SPAC, market using future projections. So if you're going to talk about things that are future-centric technologies, things like autonomous driving or LiDAR or alternative energy sources or quantum computing, we're talking about things that are going to take a few years for that high growth to really hit. And so I think, COVID has taught us that speed is key. A traditional IPO can take over a year to get done. With the right legal counsel, you can do a SPAC in a few weeks.
Let me play the role of the skeptic on it for a second. The SPACs clearly at the moment, and SPAC investors have the perceived Midas touch. Everything they're doing, it seems to get a lot of attention, a lot of interest, a lot of support from investors. But these companies are not unknown before the SPAC shows up. A lot of the time, private equity have picked over them and decided it's not a deal they want to do. They don't like the valuation. They don't like the fundamentals, whatever. So what are the SPAC investors seeing that's different from what everyone else is seeing? Or is this just they need to deploy the capital, they need to find the opportunity, so you're seeing a lot of these things get done?
Well, I think there's no question that while interest rates are low, the carrying cost of having your capital tied up in a SPAC for a couple of years is not going to be as big a consideration as in other years. But what I think is, again, these are not SPACs of prior years. Someone has called it venture at scale, and I think that's essentially what the business model is.
Arlene Hahn, their partner at White & Case, speaking with our own Ed Hammond now. Taylor, take it away. It's Muni Moment.
Let's go back to Congress and really what remains of that stalemate on additional fiscal stimulus, including, of course, crucial aid to state and local governments. Wall Street also weighing in. JP Morgan CEO Jamie Dimon scolding lawmakers for their inability to reach a compromise. For more, let's bring in Stephanie Larosiliere, Invesco, head of municipal business strategies. Stephanie, curious about, with this lack of fiscal stimulus, how much more bearish you have been on state and local government investing at this time?
Hi, Taylor. Good to see you. So in terms of, of stimulus, we believe that, stimulus at this point is needed and justified. With everything that state and local governments have been through, we at this point believe that, there is a possibility that it may get done on a lame duck, but it will likely get done, after January 2nd and after President-elect Biden takes office. And we do think that, the number's probably going to be lower than what we originally anticipated. We think that the likelihood of a divided government will lead to Biden not necessarily having the